Welcome to Market Brief After Hours. Today, we are looking at a bruising session for global markets. A massive tech sell-off that started in the US rippled across Asia and Europe, leaving a trail of red on screens worldwide. It felt like a coordinated retreat from some of the market's favorite trades, especially in the artificial intelligence and semiconductor sectors. What exactly triggered this global rout?
It was a classic domino effect, and it really gained momentum overnight. The core issue is a growing skepticism over the massive capital expenditure on AI infrastructure, paired with renewed fears that the Federal Reserve might actually raise interest rates rather than cut them. When you combine those macroeconomic anxieties with some highly crowded trades, you get a violent unwinding of positions. The tech-heavy Nasdaq composite bore the brunt of it, sliding 2.21% to close at 25,587. The broader S&P 500 wasn't spared either, falling 1.44% to end at 7,365.
And what about the blue chips? The Dow Jones Industrial Average seemed to hold up much better than the other major indexes.
It did. The Dow managed to escape relatively unscathed, ending down just 46 points, or a mere 0.09%, at 51,667. The reason for that resilience is that investors scrambled for safety. While they were dumping high-flying chip makers, they were buying defensive household names. We saw solid gains in companies like Walmart, Procter & Gamble, and Johnson & Johnson. Plus, IBM popped 5% after JP Morgan upgraded it to overweight. And we saw gains in Sherwin-Williams and Merck. So there was a very clear rotation happening under the surface.
But the real pain was in the semiconductor space. We saw some eye-watering drops there.
Absolutely. The selling in chip stocks was brutal. It was led by Micron technology, which plummeted 13%. SanDisk also dropped 13%, and components maker Seagate Technology shed more than 5%. When you look at the giants, Intel pulled back 6%, Advanced Micro Devices lost almost 6%, and Qualcomm fell 8%. If you want a sense of the industry-wide damage, the VanEck Semiconductor ETF fell a staggering 7%, and the State Street Technology Select Sector SPDR ETF dropped 4%. Even Alphabet continued its downward slide, falling another 1% after a 5% drop the previous day, which was sparked by concerns over high-profile AI talent leaving the company.
It sounds like the momentum traders who drove these AI stocks to the moon are suddenly rushing for the exits.
That is exactly what is happening. Analysts at Morgan Stanley noted that while these AI beneficiaries might not necessarily be overvalued, they are incredibly crowded trades. When everyone is positioned the same way, any shift in sentiment leads to these sharp, cascading sell-offs. In a way, many market participants view this as a healthy, albeit painful, correction.
That pain certainly wasn't confined to Wall Street. Let's look across the Pacific. Asia was absolutely routed overnight, wasn't it?
It was a sea of red. The South Korean Kospi was the hardest hit, plunging 9.99%, close at 8,204. Now, to keep things in perspective, the Kospi is still holding on to gains of more than 172% over the past year, but a 10% drop in a single day is historic. The damage was concentrated in memory chip leader SK Hynix, which has been at the center of South Korea's AI frenzy. Its shares closed down more than 12%. Japan's Nikkei 225 didn't fare much better, dropping 3.55%, or 2,566 points, to close at 69,788, breaking an 8-session winning streak. Semiconductor business Kioxia Holdings tumbled 15.1%, and Furukawa Electric plunged 15.5%.
What about China and the rest of the Asia-Pacific region?
China's Shanghai Composite Index lost 1.37%. The iShares China Large Cap ETF actually hit a new 52-week low, sitting 22% off its yearly high. In Hong Kong, the Hang Seng Index erased 1.82% to finish at 23,336. Down under, Australia's S&P ASX 200 fell 0.33%, dragged down by Technology One, which declined 7.1%. New Zealand's NZX 50 slipped a minor 0.08%. It was a comprehensive regional retreat.
And Europe followed right along when their markets opened.
Indeed, the Pan-European Stoxx 600 index closed down 0.57%. France's CAC 40 shed 0.7%, and Germany's DAX lost 0.8%. Italy's FTSE MIB dropped 1.46%. In the UK, the FTSE 100 closed just below the flat line, which was actually a decent showing considering Prime Minister Keir Starmer announced his resignation, paving the way for the country's 7th leader in 10 years. European tech stocks and miners were the biggest detractors, falling 3.4% and 3.3% respectively.
Beyond the global tech sell-off, Europe also had to deal with some pretty weak economic data, right?
Yes, the economic indicators were highly discouraging. Germany's manufacturing PMI slipped to 50 in June, down from 50.1 in May, showing that factory activity has completely stalled. Even worse, Germany's services PMI declined to 46.8, marking the third consecutive month of contraction and the lowest level since late 2022. Over in the UK, the composite PMI eased to 49.4, indicating a contraction in private sector activity after 11 months of expansion. French manufacturing confidence also ticked down to 100.0, so you have stagnant growth and high inflation fears hitting Europe all at once.
It is a tough environment for global equities right now. Let's take a quick pause, and when we come back, we will dive into the currency markets, gold's sudden dive, and some massive single stock movers you need to know about. Stay with us. Welcome back to Market Brief After Hours. Let's pivot to the foreign exchange market, where we saw some incredibly aggressive moves. The US dollar seems to be flexing its muscles against almost everything. Let's start with the euro.
The US-USD pair plunged 0.41% to close at 1.1381. Looking at the technical profile, this was an incredibly bearish session. The pair closed right near its daily low of 1.1376. What's critical for traders to note is that the price is now positioned well below all its key moving averages. The 50-day simple moving average is at 1.1645, the 100-day is at 1.1659, and the 200-day is at 1.1669. This confirms a deeply negative medium-term outlook. If the pair breaks below 1.1376, we could see a rapid acceleration toward deeper historical support levels.
And the British pound didn't fare much better against the greenback.
No. GBP/USD extended its decline, closing down 0.40% at 1.3197 after hitting a low of 1.3182. Just like the euro, the pound is trading firmly below its key moving averages. The 50-day moving average is at 1.3451, the 100-day is at 1.3440, and the 200-day is at 1.3411. The pair has broken below its recent consolidation floor, meaning sellers are firmly in control. If it stays below the session high of 1.3257, the path of least resistance is definitely lower, potentially targeting the 1.3100 region.
Now, on the flip side, the US dollar surged aggressively against the Canadian dollar.
Yes, USD CAD was on a tear, closing up 0.40% at 1.4209. This pair is in a steep vertical rally, trading far above its moving averages. The 50-day average is at 1.3803, the 100-day is at 1.3761, and the 200-day is at 1.3826. It is a completely different technical picture here. Buyers are aggressively forcing the price into new territory. Immediate support is at 1.4150, and as long as it holds above that, this bullish momentum looks set to continue.
And finally, the Australian dollar suffered a massive rejection.
The AUD-USD pair plummeted 1.24% to close at 0.6914. It touched a high of 0.7003 before sellers stepped in and pushed it all the way down near the daily low of 0.6906. It is pushed well below its 50-day moving average of 0.7133 and its 100-day of 0.7082. It is still marginally above its long-term 200-day moving average of 0.6853, which is now the critical line in the sand for the Aussie.
That is a dominant showing for the US dollar. Interestingly, despite these rate hike fears, US Treasury yields actually fell on Tuesday. Why is that?
It is a classic safe haven bid. When the stock market undergoes a violent sell-off, investors run to the safety of U.S. government bonds, which pushes bond prices up and yields down. The yield on the benchmark 10-year Treasury note fell to 4.495%, and the 2-year yield, which is highly sensitive to Federal Reserve policy, fell to 4.198%. So even though investors are worried about potential rate hikes from the Fed, the immediate panic in the stock market forced a bid into bonds.
Now, let's talk about commodities because we saw some absolute carnage in precious metals. Gold and silver both collapsed.
The moves in metals were shocking. Gold closed down 1.86% at $4,113, forming a massive bearish engulfing candle. It is trading substantially below its 50-day moving average of $4,531, its 100-day of $4,721, and its 200-day of $4,446. But silver was the real disaster, collapsing 5.18% to close at $61.65. It sliced right through its 200-day moving average of $68.34, as well as its 50-day and 100-day averages. This was pure aggressive liquidation.
Why did everything gold, silver, tech stocks, and even cryptocurrencies fold together? Bitcoin dropped over 3% to go below $62,000, and Ethereum fell over 4% to $1,657. Usually, gold acts as a hedge, but today it fell right alongside crypto and tech. What is the macro driver behind this synchronized sell-off?
There are two main mechanical drivers here. First, JP Morgan warned about massive quarter-end rebalancing. Large pension funds and sovereign wealth funds are forced to sell off equities and other high-performing assets to rebalance back to their fixed stock-to-bond targets. This mechanical selling is estimated to be as high as $165 billion worldwide through June 30th. Second, we saw violent price action in the Japanese yen. It looks like Japan may have stepped in to defend its currency. That currency intervention occurred, it violently disrupts the yen carry trade, where global investors borrow cheap yen to fund high-yielding positions in stocks, gold, and crypto. Unwinding that carry trade forces investors to liquidate unrelated assets all at once to pay back their yen loans. That explains why gold, silver, tech, and crypto all fell in unison.
That makes perfect sense. It's a liquidity squeeze. Before we wrap up, let's cover some of the dramatic single stock stories of the day. AMC Entertainment had a rough session.
A very rough session. AMC tumbled 25% to close at $2.76. The movie theater chain announced a definitive agreement with institutional investors to sell 95.3 million shares of common stock to raise about $200 million. Investors hate dilution, and they punish the stock accordingly.
We also saw a massive profit warning from Primoris Services.
Yes, Primoris Services collapsed by more than 21%. They cut their full-year profit outlook to a range of $2.05 to $2.60 per share, down from their previous estimate of $4.80 to $5.
On the positive side, Edgewell Personal Care had a great day.
Edgewell was a bright spot, closing up more than 15%. They rejected an unsolicited takeover offer from Yellowwood Partners, stating that the $30 a share offer was simply too low.
Finally, let's look at the oil market. Oil prices ticked slightly lower, with Brent crude closing at $77.08 and West Texas Intermediate settling at $73.21. Investors are keeping a close eye on the Strait of Hormuz, right?
Yes, there is a lot of confusion. Iran declared the strait closed over the weekend, but U.S. Central Command insisted it remains open. President Trump mentioned that 19 million barrels of oil flowed through the strait on Monday, describing it as a record volume. While we couldn't immediately verify that exact figure, the market is watching the shipping lanes very closely, as any actual disruption would send oil prices skyrocketing.
That brings us to the end of today's episode. If you find this useful, please follow Market Brief After Hours on your favorite podcast platform.